Hello, everybody. Happy New Year to everybody. Hope you had a great holiday. And thank you for joining us for today's public webinar, first economic release of the year that happened just a little bit ago. Good morning, Jim.
Good morning. Okay, short commercial. As you know, we do these free webinars to draw attention to our educational programs. The next program we have coming up, I believe, starts on February 22nd. It is the intensive. That's our most senior course, and it does require qualification. Pre-qualification, you have to have completed the market profile e-course. People all the time tell me
Foundation and application of the market profile e-course.
Foundation and application of the market profile. People always call and ask and say, yeah, but I've been doing this with so and so and so and so. It doesn't count. It has to be the way that we teach it, because most people do not see the market the same way I do, even though they label it market profile. This course is going to be heavily oriented towards the self-understanding portion in there, because that is just absolutely so very, very important. And let's start off with with that understanding right now. So first of all, if you look at the current market, there's a few things I want to show you. On the last FOMC day, we had a non-excess low. The reference that I have been carrying for some time, it's a little bit lower on the December contract than it was on the SEP, but the number I've been carrying right here is 47.35. That was the pullback low on the FOMC day. That became my short-term support. Most people don't understand that number, but if you take a look, when the market went through that number yesterday afternoon, you see what happened. But that is something that most people really miss the importance of. And at that level, that's where, some stronger trading money came in at that point in time. So that became a reference, and that's now been taken out. And that's where the market was working towards. And if you look from that number, there was the number, and you can see the market went up to make new highs for the end of the year, but it never really got much above that. So that was very key. Now, the other thing to keep in contact with, if by any chance you've been reading my weekend comments, the comments before the end of the year said the underlying structure was terrible, but it also said, do not fight the trend. The comment this weekend talked about the double distribution on the 29th. And even though you can say, well, there's no excess on the high, which there wasn't, but there's no excess on the low down here from Fed Day. But what I wrote this weekend was, this is the double distribution. If the market can't fill this double distribution, then then the market probably showing some weakness in here. Okay, and that's exactly what's going on. So to see the underlying structure going up was absolutely terrible. But think about this, and market is, so many times people are trying to trade by the numbers. But if you're going to be a successful trader, you have to be able to think about what is going on. You had a strong year-end rally. While the structure was terrible, the market, the momentum takes care, and it just keeps feeding on itself until it's over. Now, the thought process is, if you think about this, who wants to take profits late in the year? If they take profits late in the year, they have to pay taxes on it for last year, right? So the chances with weak underlying structure coming up, the chances are that once the new year rolls over, you can take profits because now you've got all year. You don't before you have to pay them. And I think that's what took place. We had a lot of weak money up there. They didn't really want to take the profit last year. But look what happens as soon as this year opens. The market's on its way down. So I suspect there's an awful lot of profit taking in there that people thought some of this stuff was very rich, but they didn't want to take the profit last year. Okay, so now we're coming back down and we've got our first number of the year. The underlying structure remains poor. The structure from the high down isn't much better. So there's a tremendous amount of confusion yet in this market. The market, following the release this morning, the market went down. It did not take out the FOMC low. Market was very short from yesterday. And just the fact that if you look at where the K&L period, that wasn't half back at the time, but the K&L period matched. And so the selling that took place from here wasn't strong selling. It was more or less short-term liquidation. And this is what you got here. And then you got a higher inflation number in Europe, and that put the markets down. And then you got a not so wonderful number for inflation this morning. So where we are right now, and we'll talk about this and then we'll come back. We are looking at the gap trading guidelines this morning. We've got 20 minutes till the market opens. But we are, as of right now, we are looking at a gap. Whether that gap materializes or not, I don't know. If the gap doesn't materialize, the next thing we have is a spike. A spike is the M period here. A spike is a late price break late in the previous day, and there wasn't enough time left to validate if that spike was accepted or rejected. So we have two key market profile structural components to look at this morning. We have the late spike, and the spike guidelines are if the top of the spike, which I'm going to take the top of the spike at the L period low, is resistance in there. So that's the first thing. The most negative response is to open below the low of the spike. That says the market had not gone low enough to cut off the selling. The most positive response is to open above the top of the spike. Secondly, and we've got 15 minutes or so to go, we have a potential gap. Okay, Jen, why don't you do a short commercial, and then we'll take some questions.
Okay, 1 second, and I will take the screen back here. Okay, so you can go to our website, jimdellantrading.com courses. You'll see the intensive featured up at the top there, but or from our banner on the homepage. But right now it's on sale with our early bird pricing of $1,299, and that ends on January 14th. Purchasing early always yields you the best price. And for those of you not familiar, as you heard Jim say earlier, the foundation and application of the market profile is a prerequisite requirement in order to take a live intensive with us, but we do have bundles available. I'll just point out where you can find those. You go to the courses page at the top, and you'll see that we've got discounted bundles available, and you get extra discounts for purchasing more than one course. And so you can check out each of the details for each by clicking on View Detail. But as time goes on, the price will creep up. just so that you know. And if you joined us for the last intensive, which was really a super duper awesome intensive, as per feedback that we got, we're taking that into account, the feedback that we receive each time. And so we've made tweaks and adjustments. And essentially, as you heard Jim say, we are going to be focusing a lot on the self awareness. And this is also why we've shared which books that we are doing for our book reviews. And if you check our schedule, you'll see in blue here, all of those special presentations that we have for the intensive, in addition to, obviously webinars focused just on observing the market and Jim narrating and explaining what's happening. Um, I want to say events that are in red are the economic releases. And as usual, for those of you that are new, we always have our homework workshop, which goes through how Jim goes through our top-down approach, as well as a voluntary client homework session, or week, I should say, where clients are able to email in their homework and get feedback on their homework, on pointers to do better or what things they're already doing really well. So what I just want to point out really is that these sessions, these special sessions that we're having, I think had such an impact when we made the tweak last time to the last intensive, and that's why we really want to focus on that moving forward. I don't know if you want to add something to that, Jim, but I just can't say how enjoyable it was from the participation, the questions that we received, as well as just getting feedback from people on how a lot of them had light bulb moments and things that clicked for them this time around. So for those of you that are new, haven't done an intensive with us before, definitely make sure you've done the foundation e-course. You can get a discount for doing signing up for the bundle that has more than one course in it, so that you can join us. But I mean, these sessions I just think have been really invaluable for a lot of folks, and it was rewarding for us too.
If you want to
Um,
take me back to the market, I want to
oh, sure,
talk by talking about the Best Loser Win book review.
sure. Let me I've given you screen back.
Okay, before we take questions, there's a new book out, and my personal observation is that I couldn't trade the way he trades, and I doubt if very many people can. But it is a worthwhile book to read, and the reason is that things that I've been saying for years, but I had no statistics to back it up. For example, I've been saying that the the worst thing traders do is short a trend day. And and I know that from experience. I know that from talking to Stoudemire years ago, but I had no statistics to back it up. The next thing that I've talked about is traders constantly ask me the question, how do they keep from getting out of a trade too early? And I know that that is a huge problem. That traders, that the psychological feeling, the immediate feeling that you get from taking a profit, most traders can't resist, and then it builds up a habit. Well, some of the statistics that he had from the Best Loser Wins came out of Europe. But one of the things was that was not surprising, of short-term traders, 61% of their trades were winners. However, the winners, they were net losers overall, substantially net losers overall, because they were too anxious to take the winners. They let the losses run, and they took their winners too early. That was just constant. The other thing was on trend days, which is what I've said for years, is one of the problems with trend days is that traders keep trying to buy the bottom on trend days. And the statistics prove that out. And I've said the worst thing you can do is fade a trend day, yet traders continue to do it. The idea, say for example, it's a trend day to the downside. They consistently try and buy the bottom. It's like, boy, would that feel good if I buy the bottom? And they can't resist it. Or on a trend day up, consistently try and sell the high. And traders were net losers on trend days because of that. The other thing that I said, for example, if it's a trend day to the upside, one of the things that continues to feed that trend day to the upside is that traders sell short, and then they are forced to cover that short, which adds more buying to the market. And the other thing that goes on when you get a trend day, let's say that it's a trend day and it's with the current trend, the momentum indices on a trend day are going to continue to rise. As they continue to rise, that's going to take prices even higher. You don't want to fight that. Okay, those are it's a, like I say, I was a little disappointed with the book from the point of view that I certainly couldn't trade the way he trades, and I doubt very few people can. And I've been trading 50 years. I've been on 2 floors, and I think it's unrealistic. But I think what he says about the behavior of traders and how they defeat themselves and the statistics are well worth reading and well worth understanding, particularly if you are struggling with getting your market actions under control. When you take a profit too early, you form a habit. And that once you do it twice, 3 times, it's hard to break that habit. The next intensive, we're going to work substantially on the self-awareness portion, as well as how do you address and how do you begin to work on trading habits. There's no simple answer to this. People always say, what's the quick solution? There is no quick solution. Okay, Jen, let's open up for some questions.
Okay. Okay. Do you think the shock and awe on this number has already happened this morning in the pre-market, so the chances of revisiting the low will be difficult during regular trading hours?
I have no idea. Generally speaking, what we talk about is when the market, for example, sells off prior to the opening on the NYSE, and it holds that sell-off, the market generally continues weak. If by the time the NYSE opens, the market has retraced a considerable portion of the early sell-off, generally the market is stronger. So based on that, the chances of revisiting the low in here would be low based on what we have observed in the past. Part of the situation may be that the market, since the first of the year, the market's been selling off fairly sharply, but it's gotten inventory awfully short. So much of trading has nothing to do with the investment side. It has to do with inventory getting too long and too short. And I think inventory got very short. So I think we're dealing with the potential of an inventory situation here. But generally speaking, when the market has sold off like this does, and it doesn't hold that through the opening or come close to it, generally it's not a particularly weak day. Okay, next question.
Okay. Would you consider the buying in December as more of laggard buyers?
Oh, without a question, without a question. And we use the diffusion model. I never get the name right, but it's also understandable because everybody talked about the magic of the year-end rally. So people really didn't have to think; they just blindly bought into the year-end rally. And there's nothing, as a trader, there's nothing wrong with that as long as you control your stops in there. But like I say, what I'm talking about this morning, most people, they just get carried away with the momentum and they expect that momentum to carry into the new year. And as I said, most people couldn't think through the fact that those that had extensive profits didn't want to take them last year because they had to pay tax on them. So as soon as we open this year, the potential for a profit taking is huge. And where's the profit taking been? It's been in the Magnificent Seven or whatever it is. It had, really substantial gains. Trading isn't just about numbers. So many times traders want to make it just about numbers. It's a deeper, if you're really going to be competitive, anybody can look at the numbers Anybody can look at the numbers and see those. There may be some, like I talked about the pullback low. I've not heard anybody other than us talk about that, but that was a significant number. You saw what happened yesterday. But most people really, I'm going to guess that very few people thought about the potential for profit taking immediately after the first of the year. They said, oh, it's the year-end rally, it's the Christmas rally. The Christmas rally goes into the second day, includes the first 2 trading days of the new year. So they blindly, get caught in the market. I'm going to guess there's been some fairly substantial losses from liquidation this week. So trading is about, understanding your competitors and who you are competing against and what are the expectations of what they might do. Okay, what else?
Okay. Based on news trading guidelines, we are rejecting the initial reaction. That's positive for the bulls, but against short-term trend and value. Which takes priority?
Markets always have to handle current business first. The current business this morning is working on the inventory and the numbers. Now, then you look and you say, okay, there's no real excess on the high. The current trend is short-term trend is down. Remember, we have not taken out the low of the last Fed meeting. We didn't get down there. We didn't take that out. So what we're going on in here, the trend is down. So your focus today is going to be on value. If there's any real strength in this market, you'll get back into yesterday's value and you'll start building value higher. If you build value lower, then the downward trend that started at the end of the year, at the first of the year, continues. Okay. Anything else, Jen? Jen, are you there?
I'm sorry, I was on mute. Did we have a spike yesterday, and does it come into play today?
I guess you came in late. I've already talked about that. Okay, what else?
Okay. The overnight high traded multiple times at the base of the spike. Does that increase the odds that there are stops above that?
Two things caught my, yes, I think it does. Two things caught my attention when I looked at this. The K and L period high were almost matching. And I don't normally put a lot of, focus on the overnight highs and lows. But this did catch my attention because the selling was mechanical here. It was selling at mechanical to K and L period. But as we just said, we will use the spike as our first reference for this morning. Okay, what else, Jen?
Okay, somebody's asking, oh, okay, let me take back the screen real quick and then I'll go over this question. Okay, several people are asking about the books. You can go to our website, go to resources and then books, and you can find our books list here. But the Best Loser Wins right here is the book that Jim was discussing. That's going to be, for the intensive, and the other book will be Atomic Habits by James Clear right here. So Biggest Loser Wins by Tom Hugard and Atomic Habits by James Clear. Okay, let me see here. Somebody's asking, from the same author, I learned about the Alex Honnold documentary, Free Solo. You teach the same way that Alex does his climbs with mindset, risk, and preparation. This documentary is as good as a short clip of the golfer that you once recommended. Sorry, I don't recall his name, but it could be good for you to consider too for the intensive.
Thank you.
Thank you for the suggestion.
Would you text that to us just to make sure I
Yeah,
don't
if you
forget?
could email, if the person who mentioned this comment, if you could send an email with that, that would be great, so we can check that out. And I just wanted to mention that, for Best Loser Wins, that was also a book suggestion from a client. So, we love getting those from folks. So thank you. Somebody who was in the last intensive with us here, they said that, like when I was talking about light bulb moments, when we're talking about the intensive, the last intensive. They said the fairest prices at which business is being conducted was a light bulb moment for them. Thank you.
Want to take me back to the markets, please?
Yes, let me give that to you. Anyway, I just wanted to mention before I forget, like I said, the schedule is here on our website, so you can download that so you know that the times and everything of what we're covering. It's posted in Eastern, so you'll have to, convert for your time zone. All of the webinars are recorded in case you can't attend them all live. Or for just your review, you get access to materials for a period of 1 year after the course finishes so that you have enough time to review all of these webinars. If you have any questions about, what's right for you, or you have questions about any of our courses specifically, don't hesitate to email or give us a call. I'd be happy to speak with you. Okay, Jim, I'm giving you the screen back.
Okay. Couple more questions.
I'm not seeing any specific. Oh, somebody mentioned the golfer was Phil Mickelson.
Phil
That's correct.
Nicholson, yeah.
Thank you for that. Yep. Thank you for that. Let me see here.
And the point on the Phil Mickelson thing was how much practice he did, how many shots he hit, in the practice. And that's where most people don't understand the value of preparation and homework. They just so many times want to come in, pick a couple numbers and start trading. Okay, so
Okay.
here we are. We've almost totally rejected this sell-off from this morning. That is generally a positive response. Okay, final question.
Somebody's asking if they have done some other training elsewhere. Can they still come join us for the intensive?
The
The
no.
answer to that is no. Sorry about that. It didn't always used to be that way, but we found that for the integrity of the intensive, we really needed to have a certain amount of knowledge base there, and the way that Jim intended the information. So that's something that we had to end up implementing in the past few years. Okay.
It is
So if you
amazing
got any,
how many.
Mhm.
It's amazing how many people think they understand, and when they really get here, they don't, and it's not fair to everybody else. All right, let me say thank you very much, and have a great trading day. Unless you had a final question, Jen.
No, I think we're good. I just want
All
to
right.
say you can shoot us an email at dalton@jimdaltontrading.com, or give us a call at 409-422-7250 if you'd like to ask any questions. Okay. Thank you so much. Have a great year, everybody, and we'll see you at the next one.